Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a fantastic day today. Now in today's video, we are going to be talking about emotions, how to minimize emotions when it comes with swing trading and trading in the stock market. So I hope you guys all enjoy it. If you guys are new to the channel, my name is Carter. I've been a full-time swing trader for over 6 years. And with that being said, we do have an amazing school where I teach people strategies on how to find stocks and the strategies behind buying and selling and pretty much everything you guys need to get started with trading and investing in the stock market. And right now, you guys know we're doing the $500 account challenge. And so with that being said, for the school, we're offering 50% off the school by using code challenge. This is a great way to jumpstart your education. We have private live streams, quizzes, lectures, private group chat, all that great stuff for a trader. So check it out down below. But guys, let's jump into this here. So when it comes with trading and investing into the stock market, a lot of people don't realize that, your strategy in buying and selling is only one part of what makes up, a trader. In my opinion, what makes up about 80% of trading is emotions. A lot of traders or investors, when they buy a stock and they realize the stock's going down, they have a lot of hope, and what happens is they're hopeful that their stock's going to recover, when in reality they're just wrong. And traders and investors are wrong all the time. But what separates a successful trader from a non-successful trader is the willingness to cut your losses and move on to other opportunity. I've been wrong. Everybody's been wrong. Warren Buffett, Paul Tudor Jones, Ray Dalio, all the world-class traders and investors of the world, they have been wrong. But what separates them from others is their willingness to realize they're wrong and just hop out with a small loss, compared to if you hold it and it just keeps going down and down and down and down. And another thing here is, when you're right, you're right. And what I mean by that, don't be afraid to add to your position and, really compound your profits. So I do want to show you guys 2 examples of what I mean by this. So let's jump into this here. So with Amazon, you guys know we recently took a trade right on that 90-day moving average line over, a couple weeks ago now. And you guys can see it hit it, and we had this great move all the way from 175 to 188. So before I ever take a trade, I always do my due diligence. So if we hop in here, we set our stop loss just below it right here. We have our target at 191. The risk and reward is almost 3 to 1. So risking $1 to make $3. Now, as you guys see, the stock had a great rebound and really just started rallying above this trend. Now, the first thing I did here is I had this trend line drawn out. My mindset and approach with it is, if it breaks down below this trend line, I'm wrong. The stock's and I'm just going to hop out, obviously with profit. Now, another thing here is, as the stock's going up and you realize you're right, a lot of things can happen. The first thing is you can add to your position. Adding to your position will pretty much get you a good average price for your shares. So what this means is, if you buy it for 176 and then you average more at 180, your average cost, or if you buy more at like 183, your average cost is going to be, now instead of 176, it's going to be 180. So as the stock goes up to 188, now you're compounding those profits, because your average cost is just a little bit lower and you have a lot more money invested. Now, what I always do here is I have my trend line drawn out, or my trailing stop, and you guys can see the second it broke below it, we hopped out and the stock actually continued to rally its way down a little bit. So I want to show you an example of what I mean by this, with a position that we're actually in right now. And this is ticker symbol BGC. BGC has, one of the reasons we took a trade on it, has this really nice upward trend. It's sold off down to, this $8 area. So my mindset and approach is, if we hop in here and we set our target obviously at resistance, we set our stop loss relatively tight. So look at that risk and reward, risking $1 to make over $4 a share. So what I'm doing is, if it breaks down pretty much about 2% from this moving average line or its price, I'm just gonna hop out of this position. So if we actually draw down, we can go down about 2% or so. So near and around, this 775 area. So if it breaks down below that, I'm wrong, and we're just going to hop out of the position. No harm, no foul. And this is what a lot of traders don't do, is they don't plan at all. They're not willingness to take a small hit. Their willingness to hold a position that they know isn't making them money. Don't be afraid, cut your losses. And yes, there's going to be times where you cut your losses and the stock will rebound up. It will happen. It will happen. It's happened with every trader. You know, nobody can buy at the peak bottom and at the peak top. But what we can do is have a plan, have a strategy, build up your emotions. Building up your emotions and, you know, kind of being like stone cold is super, super important when it comes with trading, because when you buy a stock, if you're wrong, cut your losses. If you're right, add to your position. It's that simple. Don't overcomplicate your trading. Keep it simple. Have that slogan, MISS, M-I-S-S. Make it simple, stupid. So guys, hope you guys all enjoyed it. If you have any questions, feel free to ask down below. We'll see you guys in the next one. Like, subscribe, and we'll see you guys later.